the housing market has undergone a significant transformation, following 2 years of remarkable growth in home sales and surging prices. One key factor in this shift is the dramatic increase in mortgage interest rates. It all began in March 2022 when the 30-year fixed-rate mortgage exceeded 4%. However, the surge did not halt there. By October of that same year, the rate had skyrocketed to a 20-year high of 7%. Though it has stabilized somewhat since then, it remains at around 6%, considerably higher than historical norms. Consequently, this surge in interest rates has prompted a decline in home prices, raising serious concerns about the future of the housing market. Concerns about a housing market crash. With interest rates now more than double what they were just a couple of years ago and a dwindling number of prospective home buyers, it is hardly surprising that the housing market has experienced a slowdown. This slowdown has raised some genuine concerns. Is it a harbinger of an impending housing market crash? Recent trends in home prices. The Case-Shiller Price Index provides us with valuable insights into the housing market's recent performance. It reveals that the National Housing Index has already decreased by approximately 2.2% this year. While a 2.2% decline may not seem substantial at first glance, experts are increasingly alarmed by the rapid pace of this decrease. Projections suggest that if these trends persist, the year 2024 could usher in some troubling developments for the housing market. Factors contributing to a housing market crash. According to experts, the housing market will encounter a series of formidable challenges in the near future. High mortgage rates, overinflated home values, reduced buyer demand, and the specter of a recession are all converging to create a precarious and demanding housing market. Selma Hepp, the deputy chief economist at CoreLogic, has voiced concerns regarding the current high mortgage rates. The impact of high mortgage rates. Hepp emphasizes that the soaring mortgage rates have priced many potential homebuyers out of the market. Additionally, the historically low affordability of homes has made it increasingly difficult for many individuals to embark on the journey of homeownership without the nagging fear that their investments will lose value. Moreover, those who acquired homes in the last 2 years at exceptionally low mortgage rates are showing little inclination to move anytime soon. They are determined to maintain their low interest rate mortgages, further exacerbating the challenges in the housing inventory. Comparison to the 2008 housing crash. The housing market today bears distinct differences from the market that crashed in 2008. A significant contrast lies in the fact that, before the previous recession, the housing market was thriving, with banks readily dispersing loans without thorough assessments of borrowers' ability to repay. There was also an optimistic belief that home values would consistently appreciate over time, enticing borrowers to take on more substantial debt. Regrettably, this optimism was proven to be overly rosy. Uncertainty in the housing market. The Federal Reserve is facing an uphill battle as it strives to maximize interest rates, but the bond market remains reluctant to align with this endeavor. This divergence is deeply unsettling. When we delve deeper into the matter, it becomes evident that investors are increasingly apprehensive about the looming specter of serious inflation. What offers us this insight? A glance at the 10-year Treasury yield tells the story. It has been on a steady ascent since early 2021. The return of risky lending practices. Another significant facet to ponder is the resurgence of precarious lending practices. In an effort to rejuvenate the housing market following the 2008 crisis, lending standards were loosened, and subprime mortgages made a comeback. The aftermath has seen a substantial surge in mortgage debt and an expanding number of borrowers grappling with high debt levels relative to their income. Mortgage delinquencies. The Federal Reserve Bank of New York reports a consistent upswing in mortgage delinquencies over recent years, marking a concerning trend that could significantly contribute to an impending housing crash. Lower equity in homes. A stark reality emerges. Nearly 50% of American homeowners possess at least 20% equity in their homes. This signifies that a substantial portion of homeowners is highly susceptible to the adverse impacts of a housing market crash. Historical trends in interest rates. The 2008 financial crisis did not take many by surprise. The root cause lay in the behavior of interest rates over the preceding 3 decades. Traditionally, interest rates had been notably higher than the present rates. Nevertheless, they have experienced a gradual descent over the past few decades. Housing bubbles and their consequences. This decline in interest rates set the stage for the formation and eventual implosion of the 2008 financial crisis. However, it wasn't a mere lack of learning from past mistakes. In the wake of the 2008 crisis, the Federal Reserve continued to slash rates to unprecedented historic lows. Oversupply of luxury properties. Yet another factor adding to the looming housing market crisis in 2023 is the overabundance of luxury properties, predominantly in specific areas. In recent years, there has been a surge in the construction and development of high-end luxury homes and apartments, particularly in major cities. Population growth and housing demand. Currently, a staggering 1.7 million homes are under construction in the U.S., an all-time high. Nevertheless, the annual population growth rate in the United States has dwindled to approximately 500,000 to 1 million individuals. While it may seem logical to presume that lower population growth would correspond to a reduction in housing demand, the reality is quite the opposite. Conclusion and future uncertainty. In summary, the housing market is navigating through a complex and challenging period. The interplay of numerous variables and factors presents a perplexing landscape, making it incredibly difficult to anticipate what lies ahead in the near future. One major factor of concern is the relentless surge in mortgage interest rates. As we've discussed, these rates have ascended to remarkable heights, reaching levels not seen in decades. This swift and substantial increase is having a profound impact on both current and prospective homeowners. The repercussions of these soaring rates ripple across the entire housing market, affecting affordability, demand, and property values. The impending threat of a housing market crash looms large. With interest rates doubling over a mere couple of years and a dwindling pool of potential buyers, the market's deceleration is a red flag that cannot be dismissed. This slowdown is prompting serious reflection and raising concerns about the prospect of a full-scale housing market crisis. Furthermore, recent trends in home prices are sounding alarms. The decline in the Case-Shiller price index, while seemingly modest at 2.2%, is occurring at an alarming pace. Projections hint at a worrisome trajectory, causing experts to ponder the potential scenarios that could unfold by the year 2024. Additionally, a set of looming challenges compounds the situation. High mortgage rates, inflated home prices, a reduced appetite among buyers, and the looming specter of a recession all contribute to the volatility and complexity of the housing market. Selma Hepp's concerns over high mortgage rates further underscore the gravity of the situation. Prospective home buyers are grappling with barriers created by these elevated rates, adding to the strain on an already stretched housing inventory. Comparing today's housing market to that which led to the 2008 financial crisis reveals significant differences. Tightened lending standards and an emphasis on responsible lending practices have evolved over the past decade. However, these distinctions do not negate the fact that we are still navigating uncharted territory, with the specter of inflation and uncertain economic indicators causing consternation. Moreover, there's the haunting prospect of an oversupply of luxury properties, particularly in urban hubs. This situation has set the stage for potential market disruptions as developers grapple with surplus inventory and lofty expectations. The relationship between population growth and housing demand is also undergoing a shift. The construction of an unprecedented 1.7 million homes in the U.S. is remarkable. However, this construction boom occurs in a context where population growth has significantly slowed. It is no longer a straightforward equation of more homes equating to higher demand. In closing, the housing market is at a crossroads, and the path ahead is laden with uncertainties. A myriad of factors, from soaring mortgage rates to an oversupply of luxury properties and changing population dynamics, contribute to this precarious and complex scenario. Understanding and navigating these intricacies will be crucial for all stakeholders, be they potential homebuyers, sellers, or real estate agents. Thank you for your attention. If you found this discussion informative, we invite you to subscribe to our channel and participate in the conversation by sharing your insights and challenges you foresee in the evolving landscape of the housing market. Your engagement is a valuable part of this ongoing dialogue.